Hello and welcome to this week's Market Matters video update. I'm Harry Watt, joined by James Gerish. We're going to talk a bunch of things today, James, but we're in the middle of March. We've gotten through reporting season. How did our portfolios perform first up in February during that difficult time that was the interim reporting season for the Aussie stocks?
Yeah, it was actually a really interesting period. So, the reporting season, you come out the other side and say, was it better or worse than expected going through it, and how did the portfolios perform? Well, I think it was a patchy, sketchy sort of reporting season, but ultimately portfolio did pretty well. We didn't have any real landmines, which is often the case when you go through reporting. A lot of when you hold a number of portfolios and stocks within those portfolios, invariably there's a few disappointments, there's a few beats, there's a few inline results. But how that transpires down to portfolio performance. So for the flagship growth portfolio, we're down 2.3% for the month of February. The market was down 2.45%, so we did slightly better than the market. Of course, that comes on the back of January, which we strongly outperformed. If I think about the portfolio this financial year to date, we're up nearly 19% FY23 to date. The market's up 13.8%, so we're really happy with how that portfolio has progressed this financial year. And looking longer term, we're the 3-year view, we're up sort of 14% per annum in that portfolio over a 3-year view. The active income portfolio fell 1.67%, so that's the lower risk portfolio within our stable, holds equities as well as hybrids and other fixed income investments. So that was down 1.67%. As I said, the market, the broader market was down about 2.5%. It's up nearly 9% FY23 to date and 10% over the last 3 years. So again, we're really comfortable with how that portfolio is progressing. Very different to the growth portfolio. It sort of suits a different sort of investor. Emerging companies fell 4.24%, which was pretty much in line with the market for the month. That's up 11.84% this financial year to date, and it's up from inception. It hasn't been going as long, but it's up 7% versus the index, which is up about 4%. And the international equities portfolio was up. It was actually flat on the month. And is up 13.5% FY23 to date, and is tracking at about 13% for the last 3 years. So a mouthful there, Harry. I've been speaking for a lot, but we're reasonably comfortable with how our portfolio is positioned. Flagship growth portfolio has been our star this financial year to date.
Yeah, doing well there. It was sort of good to not talk about central banks so much in February, but now that we've passed the first Tuesday of March, we've had the RBA hike, but they came out with some more dovish tones. In terms of the Fed, we've heard some talk from Jerome Powell there on a different skew as well. And now that that's playing on markets, how do you see this one playing out in terms of interest rates moving forward, James?
Yeah, pretty contradictory views coming out of our own central bank here, and what we saw over in the US with the Fed Chair Jerome Powell at his biannual Senate committee testimony, etc. So basically what's happening in Australia, the RBA is saying they raised rates by 25 basis points, but they're now highlighting a few weakening indicators, which could perhaps imply that they're not going to raise again. So to me, I think the key takeaway from the RBA is we're near a top in interest rates in this cycle at least, so 3.6%. Our view is we'll probably go another one, so they'll top out at 3.85%. But importantly, bond markets are pricing rates a lot higher than that. So ultimately, if that plays out, that's actually a bullish scenario for Australia. And on a relative performance, what we think you'll see as well is that overseas money, these currencies, 65 cents. We've got a central bank pausing versus other central banks, namely the US, which is still in a hiking bias. You'll get overseas capital flow into Australia, so it's a real possibility. You made mention of the Fed. They're obviously still on a more hawkish rhetoric and a more hawkish trajectory. We think the differential between our rates is going to continue to expand. So again, that is obviously it's a negative for the Aussie in the currency from a currency perspective, but a positive, I think, for our stock market. So, nearing that ending cycle, that's ultimately a more bullish tone, Harry.
Yeah, very interesting to see Jerome Powell switch from disinflationary talk to more hawkish tones at the latest meeting there.
You don't like. I mean, you look at the data over there, and CPI's been coming down month on month for the last 9 straight months. I mean, it's there are. I think what's spooking him is perhaps the rhetoric coming from corporate America. They're saying it's reasonably buoyant out there, so they're not seeing a big deterioration from an economic standpoint. Interesting, Bloomberg, and we touched on this morning, Bloomberg did a bit of a quant survey about the use of the term soft landing in this last quarterly update from US corporates, and there's been, CEOs are using that term more than they have in a long time. So I guess there's a more optimism being built into what the US economy is doing, and that's feeding into the Fed's rhetoric around higher rates for longer. But the swaps market over there is already pricing rates to peak at 5.6%. So again, the market's pricing these rate hikes that we're seeing now. So I guess that's why we don't want to hang our hats on too much of a view, because this is an evolving beast. And I think one of the things we've done well this year is sort of moving as we see it, as we see the market changing. And really targeting sectors in the market that benefit from the prevailing macro conditions, and that's what we'll continue to do, Harry.
Yeah, speaking on that, how does this play into portfolio strategy moving into March and into the end of the financial year at the moment, James?
So we've got a view, and we've written about it a lot, that we think bond yields are nearing a peak. We've been more bullish on the technology story. We got into it probably a little bit early, midway through last year, or went overweight that space a little bit midway through this last year, but it's paid off for us in more recent times. We think that the technology stocks collectively have pulled back in the last couple of weeks. We think that's another buying opportunity. We're actually in the market today buying some SEEK. But if you think about, so technology is one, we're keen on it. And Xero came out today. It was a really good example. And there's been another couple of clear examples we wrote about this week in our overseas portfolio about tech companies reducing the spend on headcount, R&D, marketing, etc., to turn the dial on profitability, and the stock rallies. So last year and the year before, it was always all about growth because you had availability of cheap capital. Now it's around profitability, and they can turn their dial on, or most of them can turn their dial on profitability, and that's what they're doing. Xero was trading up 8-9% when we left the desk just before. So we own Xero and are bullish that stock, if you're wondering.
High quality tech, I think, is the key there. The low quality tech, the performers that might see their margins get squeezed in this environment, and they don't really have that cost out ability that will really hamper growth, will be the issue.
If you've had you look at companies performing through downturns or tougher environments, and we've been through a tougher environment, those companies that can actually, their business does well through that period, or at least stays stable. Their customers are sticky. They're introducing new products. Bear in mind, there's been a lot of price rises pushed through as well to customers that they've had to suck up. So that shows you that there's got a good business. WiseTech was one that springs to mind. I mean, it's not one we own. We haven't been anywhere in this stock, so we can't hang our hats on it. But that's a company that's growing customers, and the customers they've got are spending more on different product suites. So they like it. Like that's the sort of tech operation that you should own. I mean, that one's really expensive, and there are other cheaper ones that we're targeting. But it goes to show what can be achieved when you've got sticky customers who really rate what you do.
Yeah, hold on to them. Speaking of another sort of change of pace in the market, property stocks and construction-linked stocks, their customers aren't as sticky, and the fund flowing into that sector can be really, can see really massive swings, but it does also tend to be an area of the market that does get some support coming out of a softer economic cycle. How are we seeing this space? We wrote about it in the AM today. Just touch on that one for the subscribers and the listeners out there.
So we framed today's report all around, have they moved? Like, has construction property stocks moved ahead of the slowdown? So you look at, you look at James Hardie, you look at Reece, you look at Reliance Worldwide, you look at CSR. These are all companies that are down 50% plus from their high to low. So there's a lot of pain being already built into that space. What we're musing this morning is that enough, and does the market, because it's forward looking, is it going to start pricing the recovery? We've started to buy in this area, so we've bought James Hardie in our flagship growth portfolio. We're not going hard in it yet, but I think, as the recovery, as we move through probably in Q2 of this year, in this calendar year, then that's an area that we'll be hunting in. We see value there. It often turns before the rhetoric of the underlying economy turns. So it's certainly one that we're looking at and wanting to position our portfolios more towards, Harry.
All right, that's all we've got time for today. Thanks for joining us on today's Market Matters video update. I hope you enjoyed and I hope you got something out of it.